Most people think the moment they get approved for a loan, they're moving forward in life. New car, better phone, bigger house, smoother lifestyle. It feels like progress. It feels responsible. It even feels mature. But here is the uncomfortable truth almost no one talks about. Most loan advice you've heard is quietly making your financial life worse, not better. If loans really worked the way they're advertised, people taking them would feel freer every year, not more stressed. Yet everywhere you look, smart, hardworking people are trapped in monthly payments, constantly worried about income, and one emergency away from panic. That's not bad luck, that's the system working exactly as designed. You've probably heard this advice before. Good loans are fine, as long as you can afford the EMI. Go for it, or taking loans builds discipline. On the surface, it sounds logical, even comforting. The problem is, this advice focuses only on numbers and completely ignores human behavior. It assumes your income will always be stable, your expenses will stay predictable, and your life will follow a straight line. Real life doesn't work like that. Jobs change, health issues appear, family responsibilities grow, and the loan you confidently took when things were calm suddenly becomes the heaviest weight in your daily decisions. What makes this even more dangerous is how normal debt has become. Paying EMIs on time is celebrated like a win. Upgrading your lifestyle through monthly payments is treated as smart planning. But no one sits you down and explains the real cost. Not just interest, but lost flexibility, constant mental pressure, and the silent limitation on your future choices. Loans don't just take money from your account. They take options from your life. You stop asking, what do I want to do? And start asking, what can I afford without missing a payment? This video isn't about saying loans are evil, or that you should never borrow money. That kind of extreme thinking is just as misleading. This is about exposing why most popular loan advice is incomplete, oversimplified, and often dangerous when followed blindly. By the end of this video, you'll understand why feeling comfortable with debt is actually a warning sign, how loans subtly control your behavior, and how to think about borrowing in a way that protects your future instead of slowly suffocating it. If you've ever felt proud of managing EMIs, but still uneasy about money, this conversation might change how you see loans forever. When people talk about loans, they love using one comforting phrase: good debt, education loan, home loan, business loan. These are labeled as smart moves, almost like badges of responsibility. The moment something is called a good loan, people stop questioning it. They stop calculating risk. They stop imagining worst-case scenarios. The label does the thinking for them. But money doesn't understand labels. Interest doesn't care if your loan is for education or a luxury car. The bank doesn't pause payments because your plan didn't work out. A loan is a legal obligation, not a motivational tool. And the moment you forget that, you're already vulnerable. Here's the uncomfortable part. Many people take good loans not because they're financially ready, but because the loan gives them permission to move faster than their income allows. It feels like progress without patience, and patience is exactly what modern financial advice tries to remove. You're told future income will handle it. You're told this investment will pay off. But future income is not guaranteed, it's a hope. When that hope doesn't materialize on time, the loan doesn't disappear. It tightens, and suddenly, a good loan starts dictating career choices, lifestyle decisions, even mental health. Another thing no one talks about is how good loans encourage overconfidence. Once you believe a loan is smart by default, you stop asking the most important question: what happens if things go wrong? Most people don't run scenarios where income drops, expenses rise, or priorities change. They assume life will remain stable long enough to justify the loan. That assumption is where damage begins, because stability is temporary, but loans are fixed. The biggest myth here is that intention makes a loan safe. Just because you intend to use it wisely doesn't mean the outcome will be wise. The world doesn't reward intention. It reacts to reality, and reality includes uncertainty. A loan taken under the belief that this is good debt often becomes the very thing that limits growth later. Not because the person was irresponsible, but because the advice ignored human vulnerability. A loan should be evaluated not by what it's called, but by how much pressure it adds to your life when things don't go as planned. That's the difference most advice never explains. One of the most powerful tricks loans play is disguising the real cost behind a small monthly number. EMI culture has completely changed how people think about money. Instead of asking, "Can I afford this?" people ask, "Can I manage the EMI?" That single shift is dangerous, because managing a payment is not the same as owning something comfortably. When your focus is on the monthly amount, the total cost fades into the background. And that's exactly where lenders want it. A product that feels expensive upfront suddenly feels reasonable when broken into small payments. The brain loves this. It feels lighter, less painful. But pain delayed is not pain removed. It's just spread out, quietly following you month after month. Most people never sit down and calculate how much extra they're paying over time. And even when they do, they emotionally disconnect from that number because it feels distant. What feels real is the EMI hitting the account every month. This creates a dangerous illusion of afford. You feel richer than you actually are. You start stacking commitments. One EMI doesn't feel heavy, but 5 of them slowly choke your cash flow. And because each one individually felt manageable, you don't notice the trap until flexibility is gone. Suddenly, a small income disruption becomes a crisis. Not because income dropped to zero, but because every rupee already has a job assigned to it. EMIs also push people into early lifestyle upgrades. You don't grow into a lifestyle anymore, you borrow your way into it. And once your lifestyle is financed by future income, stepping back feels like failure. So you keep pushing forward, even when it's uncomfortable. This is how people look financially successful on the outside, but feel constantly anxious on the inside. The most dangerous part is how normal this has become. Everyone around you is doing it, so it must be fine. But normalization doesn't equal safety. It just means the problem is widespread. EMIs don't just change your bank statement. They change how you think about money. You stop seeing money as freedom and start seeing it as obligation management. And once your financial life becomes about maintaining payments instead of building options, you're no longer in control, even if everything looks fine on paper. Most loan advice sounds smart because it's built on ideal assumptions. It assumes you'll always behave rationally. It assumes discipline will never fade. It assumes emergencies are rare and manageable. In theory, if everything goes right, loans can be handled perfectly. But money problems don't come from theory, they come from life. And life is messy, emotional, and unpredictable. Human behavior changes under pressure. When income is steady, a loan feels harmless. But stress changes decision-making. Fear reduces patience. Obligations reduce risk tolerance. A person with heavy debt doesn't think the same way as a person without it. They avoid opportunities that might temporarily reduce income. They stick with safe but limiting choices. Not because they lack ambition, but because failure is no longer affordable. Most advice ignores this psychological shift. It treats debt as a neutral tool, when in reality, it actively reshapes behavior. A loan quietly narrows your options long before it causes financial damage. You might stop considering a career switch. You might delay starting something new. You might stay in situations longer than you should. All because the loan needs certainty, and life rarely offers it. There's also the emotional toll. Knowing money is already promised creates constant background stress. Even if you're paying on time, the obligation never leaves your mind. It follows you into decisions, conversations, and plans. This mental load is rarely included in financial calculations, yet it affects quality of life more than interest rates ever will. Another problem is overconfidence during good times. When things are going well, people take on more debt, believing they've figured it out. But success phases often end quietly, not dramatically. Income slowly tightens, expenses creep up, and by the time stress becomes visible, the commitments are already locked in. Loan advice rarely prepares people for gradual decline, only sudden disasters. The truth is simple but uncomfortable. Loans reduce margin for error, and humans need margin for error more than perfect spreadsheets. Any advice that ignores how people actually behave under stress is incomplete. Loans don't just test your math skills, they test your emotional resilience. And that's a test most people were never trained to take. Banks and lenders often position themselves as partners in your financial journey, but their business model depends on one thing: long-term borrowing. The longer you stay in debt, the more profitable you become, even if you never miss a payment. This isn't evil, it's business. The problem is when people mistake alignment of convenience for alignment of interest. When you're encouraged to manage debt instead of eliminate it, that's a signal. Minimum payments, extended tenures, refinancing options, all of these reduce short-term pain while increasing long-term dependence. You feel relief, not freedom. And relief is addictive. It keeps you in the system longer. Paying on time is praised because it makes you a reliable customer, not because it makes you financially strong. From a bank's perspective, the perfect borrower is someone who never defaults and never finishes early. That person generates predictable profit. But from a personal finance perspective, predictability is a trap. Life doesn't reward predictability. It demands adaptability. Refinancing is often sold as a smart move, and sometimes it is. But more often, it stretches debt across more years, turning a temporary burden into a permanent backlog. The payment feels lighter, but the obligation lives longer. This is how people spend decades paying for decisions made in a few optimistic moments. What's rarely said out loud is that financial systems are optimized for participation, not liberation. You're rewarded for staying inside the cycle, not for escaping it. That doesn't mean you should avoid loans at all costs. It means you should never confuse convenience with benefit. Understanding this changes how you see advice. When someone tells you debt is normal, ask who benefits from that normal. When someone says everyone does it, ask whether everyone is actually winning. Because if debt was truly neutral, it wouldn't shape behavior, limit choices, or quietly drain opportunity. The system works smoothly, just not always in your favor. The biggest cost of loans isn't interest, it's opportunity. Money committed to repayments can't be redirected when chances appear. When life offers a window to invest, to move, to start, to pause, debt limits your response. You don't see this loss on statements, but you feel it in hesitation. Loans also create mental accounting. You divide income into already spent and maybe usable. Over time, the usable part shrinks. This creates a scarcity mindset. Even at decent income levels, you start playing defense instead of offense. Protecting stability becomes more important than creating growth. There's also the cost of delayed courage. Many people postpone meaningful decisions because the timing doesn't feel safe. And timing rarely feels safe when obligations are high. So years pass, plans stay ideas, and the loan that was supposed to help life move faster actually slows it down. Stress compounds this effect. Constant low-level pressure drains energy. Decision fatigue sets in. You avoid thinking about money because thinking about it is uncomfortable. Ironically, this avoidance leads to worse decisions, not reckless ones, cautious, limiting ones. What makes this dangerous is that it's invisible. There's no dramatic failure, no obvious mistake, just a gradual narrowing of life. And because it happens slowly, people normalize it. They believe this is just how adulthood feels. It's not. It's how obligation overload feels. Freedom in finance isn't about having zero debt. It's about having space. Space to adapt. Space to recover. Space to choose. Loans consume space. Sometimes the trade-off is worth it. Often, it's not. But you can't evaluate that trade-off if advice only talks about rates and ignores reality. The right way to think about loans is not whether you can afford them today, but how they behave when life becomes uncomfortable. A loan that looks fine in stable conditions can become suffocating under pressure. That's the real test, not afford resilience. Before borrowing, the most important question isn't about interest or tenure. It's about flexibility. Does this loan increase your options or reduce them? Does it buy freedom or sell future choices? If the loan demands predictability from an unpredictable life, the risk is higher than it appears. Loans should come with exit plans, not just approval celebrations. Knowing exactly how and when you lines remove the obligation matters more than how easily you enter it. Debt entered casually is rarely exited strategically. Another rule is emotional clarity. If a loan helps you sleep better, plan better, and breathe easier, it may be serving you. If it sits quietly in your mind, creating background tension, it's already costing more than money. Stress is an expense too. The goal isn't to fear debt, but to respect its power. Normalizing loans without understanding their psychological and opportunity costs is what causes damage. Financial strength isn't about juggling obligations efficiently. It's about needing fewer of them. The most dangerous loan isn't the one with a high interest rate. It's the one that feels harmless. The one that blends into life so smoothly that you stop noticing what it's taking away. Once you see that, loan advice stops sounding so comforting and starts sounding incomplete. If there's one idea I want you to walk away with, it is this. Loans don't usually ruin people overnight, they slowly shrink their freedom. Most advice talks about interest rates, EMIs, and eligibility, but almost no one talks about what debt does to your choices, your mindset, and your future. Once you start seeing loans not just as money, but as long-term commitments that demand predictability from an unpredictable life, everything changes. You stop asking, "Can I get approved?" and start asking, "What will this cost me if things don't go perfectly?" That shift alone can protect you from years of silent stress. This isn't about fear or guilt. It's about clarity. When you understand how normal debt quietly shapes behavior, you regain control. You realize that financial strength isn't about managing payments smoothly. It is about building flexibility, options, and breathing room. The real goal is not to look financially successful, but to feel secure enough to make honest decisions without pressure sitting in the background. If this way of thinking about money made sense to you, then you'll probably enjoy the conversations we have here. On Money Uncovered, we break down uncomfortable financial truths that most people avoid, without hype and without sugarcoating. If you want to think differently about money, decisions, and long-term freedom, make sure you subscribe to Money Uncovered and stay connected. More videos like this are coming, and they might change how you see money for good.